talk about the final one, ITM binaries, which stands for in the money binaries. And then I think based on what we've covered, you pretty much already know what that means, all right? But what is an in the money binary? Well, let's just look at some examples here, all right? I'm going to get out of this just so we can clear it out of here. Okay, right here, euro dollar to be above, or let me show you a different example here. Let's see. Okay, so we understand what out of the money is. Those are way out there. We understand what the at the money is, where it's right close to the market. Okay, the market and the strike price are right close together there. And let's take a look here. All right. So this contract here, euro dollar to be greater than 0.898. Okay. Where's the market right now? 0.906. Right? So the market's quite a bit higher. Let's take a look here. Let me just clear everything off of here. Okay. So this contract says what? The euro dollar be greater than 0.898. Well, let's look at a euro dollar chart. Let's find 0.898. Okay. 0.898. So if I buy this strike price right here, what am I saying? If I buy this, I'm saying that the euro dollar will be greater than this price. Well, it's already greater than that price, isn't it? Right? So, where did it go? I'm sorry. Yeah, 0.898. So also look where it's priced at. When I buy it for $92. It's getting close to that $100 mark, right? Why is that? Why do you think it's priced so close to $100? Well, I think you can see that because it has a really high probability of that happening, right? Because the market's already above there. Okay? What can the market do? Well, if I buy this strike price and the market goes up from where it is right now, do I win or lose at expiration? I win, right? Because I'm saying the market has to be above this strike price. It's already right here. If it keeps going up, I win. What if the market just went flat and just did nothing and stayed right where it is right here, all the way to expiration, and I had bought this binary? Do I win or lose? I still win, right? Still win. What happens if I buy this binary and the market starts to come down? And it comes all the way down, come on, to right here. And then it expires. Do I win or lose? I still win. Still win, okay? When we talked about out of the money binaries, what did the market have to do? If I bought an out of the money binary way up here, what does the market absolutely have to do? There's only one thing the market can do for that to make me any money at all. If I bought something way up here, what is the one thing the market absolutely has to do? Only one option. It has to move, and it has to move up. It can't stay flat, can't go down. The market can, if I bought way up here, the market can only go up. It has to move and has to move up, right? Out of the money. What if I bought an at the money binary right here? I bought a binary right there, buying, saying the market is going to be above. What does the market absolutely have to do? Only one thing, move up. Right? Does that make sense? If I bought an at the money for 50 bucks right where the market is, the market has to pop over that 50% hurdle, right? Pop over the top of it. Has to be at least one tick in the money there. has to move up. So with out of the money and with at the money, the market has to go one direction, right? Everybody follow me there? Has to go that direction. With an in the money binary, if I bought a binary way down here, what can the market do? It can go up, it can stay flat, it can even come down against me as long as it doesn't come all the way to my strike price. Does that make sense of what an in the money binary is and why I have more options there? Now granted, I had to pay more and risk more for it, didn't I? But I have a lot more options, and let's say that I did buy, and I'll show you another example in a minute. I can buy it for 94, sell it for 85. So what is my probability? About 90%, right? That has a much higher probability than some of these $8 ones we looked at, didn't it? So we've got a much higher probability of from a statistical standpoint of the in the money binaries expiring profitable, right? But do I want to be risking $94 on a trade to only make $5? Even though it has a real high probability, is that probably a good thing to do, to risk $94 to only make 5? Not really, no. Even with a high probability, it doesn't work out, does it? But you understand now, though, why it's priced higher. You understand why it's an in the money binary. And you understand that when you do buy a binary down here, you have a lot more options for what the market can do. Or if you sold a binary up here saying, hey, the market will be below this, you've got a lot more options, right? Because the market can go up, go down a little bit, or stay flat. That makes sense? Any questions on that in and of itself, as far as understanding that you have 3 options for the market now? It can go up, stay flat, or come down a little bit. Does that make sense? Yeah, David, is this something you would do in a flatter market? Absolutely. Absolutely. Using those in the money binaries in a flatter market? Absolutely. Okay. But now, let me show you a little bit different example here. Okay, I just wanted you to get the concept. All right, let's look at, let me find a good example here just to show you. We've been looking at euro dollar. Now I want to stay on euro dollar because I have the, that's the chart I have up. Okay. Okay, this binary right here, I can buy it right now for about $71, right? Okay, 0906 is the strike price. So let's look here. Let's find 0906 right there. Everybody see that? So if I bought that strike right there for around 70, what was it at? 70, it was about $70, right? It was 72 a minute ago, about $70. Okay, how much can I make if I'm right? If I buy it for 70, it expires profitable, worth 100, I can make $30. Do I really want to risk 70 to only make 30? I mean, granted, it's in the money, so it's got a higher probability, but do I really want to risk 70 to make 30? Maybe, but maybe not. Not really, right? So So let me ask you a question. If I bought this one, or no, what if I bought this one? What is my probability of it winning? Just from the number statistical side. About 30%, right? We all understand that. Well, what do we like about this? Ooh, I only have to risk $32 on this one. We like that, right? We all like that. That feels a lot better than risking 70, doesn't it? Because the low investment, the low risk, I like that. I can handle about a $30 loss. I could risk 30 bucks, but I only have about a 30% probability. I really like the 70% probability, right? We like that higher probability, don't we? For this one that we looked at here, I like that probability, but I really liked that $30 risk on the other one. So let me ask a question. My strategy, my system, my charts, my indicators telling me market is going up. So therefore, I want to buy. So I buy this strike price right here. $70 risk, close to a 70% probability. I like that. I like the probability. So if the market goes up, what happens? If I'm right, market goes up, I win. Cool. I like it. I win 30 bucks, right? Market just stays flat right where it is. And then it expires. Again, do I win or lose? I win. I still win, right? If the market comes down all the way to right here, 0906, it comes all the way down, but still is above my strike, I still win. What happens before expiration? Let's say I buy this for 70 bucks. Market's kind of coming up and down, coming up and down. Maybe I was wrong. The market comes all the way down and it hits this strike price. The strike price I bought at 0906. The market comes all the way down to 0906 before expiration. What is that binary going to be worth? No. Before expiration, not at expiration, before expiration. That will make it an at the money binary, right? Because my strike is the same price as the market. And what do we know? Whether it's an hour out, 2 hours out, or a week out, when the strike price and the market price are the same, a binary is worth 50 bucks, correct? So when I enter this trade, I risked 70 bucks to make 30. Because I think the market's going up. What if I'm wrong and the market comes down to my strike? What could I do right there? I could get out of the trade, right? I could exit that trade. And what confidence do I have? What is it that I know, whether a binary has an hour, 2 hours, 12 hours, or a week to expiration? What do I know my binary would be approximately worth? Around like 45, 50 bucks, right? So if I bought it for 70 and I got to get out of it at around 45 or 50, what did I lose? 25 bucks. Right? Everybody follow me there? I bought it for 70. The market comes down against me, hits my strike. I get out of it at 50. So what did I lose? 20 bucks. What could I have made, though, if I was right and it expired profitable? 30 bucks. So I like getting this in the money strike that has more like a 70% chance of winning as opposed to an 8% chance, right? I like this higher probability. We all like that, right? If we're going to trade, I want a 70-something% probability, not an 8, right? So I like having a higher probability, but I don't like risking $70. But I don't have to, do I? Because I know if the market comes down and hits my strike, I can get out of it around $50. So I take advantage of one of these in the money strikes that has a higher probability because it's down here below the market. But I don't have to take on that whole $70 risk to get that probability. If I know I can get out of it, if I can buy it at 70, get out of it at 50, I'm only risking $20 to potentially make $30 and to be able to utilize a high probability strike, not a lower one that's way out here. Does that make sense? Did I lose anybody there? Let me know if I did, because this is very, very key. Like, this kind of wraps everything I've been kind of covering with you tonight was ultimately to get to this. This kind of wraps the whole thing up and really kind of puts it all together for you. Okay? Does that make sense? Okay, JP says then you must take, yes. If you do that, then yes, you must take that loss. If it comes down and hits your strike and you get out, well, what if it comes back though? That can happen. But what if it doesn't? Would you rather take a $20 loss and stick to your system? Or, boom, take a whole $70 loss because you held on to it just hoping and maybe it'll come back? You know what I mean? You got to stick to that. You got to stick to that system. Okay? So that's kind of where I was wanting to ultimately get to with this. And I'm not pushing you towards just in the money binaries. I told you we trade them all. My point was, do you now get the power of understanding that an at the money binary is going to always be worth close to around $50? And you see why that's important to know that now? Because if you know that when the strike is 0908 and the market's 0908, it's around an average of $50. And if you know that, you know where you can put a stop of, hey, I think the market's going up, so I'm going to buy down here. But if the market, and I'm wrong and it comes down to there, I'm going to get out of it around $50. I know going into it, even if I paid 75 for it, I know I can get out of it around 50 if it comes down. Okay, does that make sense? Of some of you are like, okay, fine, out of the money, at the money, who cares? That's why you care. It's because, like I said, you guys love, oh, look, $29 risk. I like that. You can still get this one right here, or this one right here, or this one right. You can still get an in the money binary that is below the market, has a higher probability, and exit it early, and still only have that $20 or $30 risk, but put probability in your favor. Okay? But to do that, you have to be disciplined to exit when it gets your strike. Okay? All right. Somebody asked to please repeat it, so I just want to cover it briefly. Let's look for real quick at this example right here. This contract says the euro dollar would be greater than 0906. Well, right now the market's at 0909. So the market's already greater. I can buy it for $72, 0906. So here's the market right now. The contract I'm going to buy is right here at 0906. Okay? So when I buy this contract for $70, I'm saying the market's going to expire above this price. Well, it's already above it. It's already above it. Okay, so as long as the market goes up, or if the market stays right where it is, or even if the market comes down to right here, but doesn't come all the way to the strike, I still win because I'm buying so far below here. The market can go up, come down. As long as it stays above this strike, I win. It expires profitable. I bought it for 70. It'll expire being worth 100. So I made 30 bucks. Okay. But if the market comes down and hits this price, like before expiration, and hits this price, I can just get out of this trade. I can exit it early and get out of it for around 50 bucks. We know that. We've shown those examples. So I bought it for 70, saying the market's going to go up and stay up. But if I'm wrong and it comes down, I don't have to risk the whole 70 bucks. If it comes down and hits that strike price, I know I can get out of it for about 45 or 50 bucks. So I take a $20, $25 loss on it. But if I was right, I would have made 30 bucks. So I can risk 20, 25 to make 30. That's a good risk reward. I don't have to risk 70. I don't have to risk 74 to make 26. I can risk about 25 to make 25. Does that make sense? Okay. And so yeah. Let's see here, Graham. How do you know it's at 50% when you have to get out of it without opening up the chart? Well, Graham, you should never be in one without opening up a chart, first of all. Okay? Because you don't want to just randomly take trades without looking at a chart. Like the only reason to ever get into a trade ever is because you're looking at a chart and you have a strategy or system that you're following, and whatever indicators and system you're using is giving you an up signal, telling you the market's going up. So you would have a chart open already to enter the trade. Okay? Now, if for whatever reason you entered a trade and then had to close your chart, well, all you got to do is look right here. When you get into a trade, for example, let's say we did buy this one, okay? So, all right, Graham, so I entered that trade. I bought it for 75, okay? So if it expires in the money, profitable, I can make 25 bucks on it, right? But if it went down, see, look right here. What is this strike? 0910, what's the market at? 0911, real close, about 50 bucks. So I bought this strike price right here, 0906. Let's say for whatever reason I had the chart closed because I had to after I entered the trade. All I got to do is just keep an eye right here on this NADEX indicative. See, it's at 0911. So if I see this starting to go against me, and I'll also see this, number going down here too. If this 0912 gets down to 0906, I get out of it. I open it and get out. Okay. Does that make sense? If for some reason you have your chart open, you enter the trade, but you had to close your chart for whatever reason, all you got to do is just watch the indicative right here, and you'll see, it's listed here or it's listed here, and you'll also see your pricing get down, to around 50. As soon as this hits that, boom, you can get out of it. Okay. David, you can enter this take profit order, but you cannot enter a stop loss ticket on NADEX because everything on NADEX is a limit order. Meaning, if I said right now I want to sell this for 50, what I'm saying is I want to sell it for 50 or more. And right now, I can sell it for 77, so it would fill me automatically. It would totally fill me automatically. Okay? So that's why I can set a take profit order, because I can put that as a working order because the market hasn't reached that price yet. But if I enter something below the market to sell it, it's going to sell it higher for me because I can sell it higher. Okay? Yes, Susan, exactly. Yep, you get out at the strike price that you entered the trade at. So right here we bought the 0906. If the market came down to 0906, boom, get out of it. Okay. Let's see here. William, I placed a demo trade and the price was in the money, but it still shows a red for profit. Yes, that's correct. That's always going to happen. Look right here. See this? Well, look at this one. This is deep in the money. 0902, right? I can buy it for 92 bucks. But what can I sell it for right now, William, to get out of it? 83. So it's automatically, as soon as I get in that trade, even though it's an in the money strike, it's going to automatically right away show me as being down $9, because if I want to sell it right now to get out of it, that's what I can sell it for. That P&L is just showing you right now if you want to get out of it, what you can get out of it for, not what it would be at expiration. Does that make sense? Okay. So anytime you enter a trade on Nadex, it's almost always going to immediately show you a few dollars down, because it's this difference right here of the buy and sell. Now, as the market starts moving in your direction and time goes by closer to expiration, then these prices will start to go up. Okay. So yeah, you got to get past that bid-ask spread there. Does that make sense? It's not going to automatically show you, you know, profitable yet until the price comes up to make it profitable, as far as what you can get out of it for immediately. Okay. So yeah, don't necessarily watch your P&L for getting out. Exactly. Don't watch this for getting out. You always watch your strike. When the indicative gets to the strike, you get out. You're not looking at your profit and loss. You're not trading off of emotion or a P&L number. You're trading off of, if I bought this strike here, I'm getting out when the market hits that strike there. You're just looking at the price, or you're looking at the indicative, not the price. Does that make sense? Yes, just the facts. You're trading what the chart is telling you, not what your emotions want to tell you by this number right here. Okay. So Steve is pretty close. It might be a couple ticks off. You just have to, it all depends on, you know, like right here, what are we at? 91.01 right here, 90, oh, I'm sorry, 0910 compared to 09102. I mean, they're real close there. Okay. Let's see here. Okay, that was let's see here. Just trying to catch up on some questions here. JP, that means good till close. Well, Steve, the Nadex indicative, the way it works is basically the Nadex indicative, like with Forex, for example, I believe. What they do is they take the last 30 transactions, like the last 30 orders, they get rid of the top, the highest 5, the lowest 5, and they average out the middle, or maybe it's 25. That way you're not hit by like the last little spike, you know, because with a binary contract comes down to like the 10th of a tick, and somebody or some institution placed some big order at a higher price, it's going with like a mid price, all right, to protect you from those spikes. Okay. Let's see here. All right. If I'm long at a certain strike price, then Eric, let's see here. If I'm long at a certain strike price, then short at the immediate strike price below my long position, is that as close I can get to a straddle? Let's see here. You could do that way. The way we do straddles, though, a little bit different. We do straddles with Nadex spreads. Can't really do an ideal straddle with binaries. We do them with Nadex spreads. If you go on our website here under questions, trading questions forum, Let's see here. Go down to, or you can even just search it right here. I'm sorry. Let's do straddle. Let's see here. Right there, placing a straddle trade. Okay. We do straddles with the Nadex spreads, and we do what's called strangles with the binaries. And again, if you're here on the Binary Essentials tab, trading system courses, out of the money, at the money, in the money binaries, how they work. I've showed you where you can get some more in charts and indicators and strategies and systems. Don't just randomly go buy stuff or sell stuff because you like a price or you like the low risk. You really have to understand that each one is there for a different reason. Okay, there's different times to use out of the money binaries when it's volatile and moving. There's different times to use in the money when the market can be flat. Next week, we're